The local bourse is expected to feel the squeeze as China tightens tech rules. The ripple effect is expected to be felt through market heavyweights. Naspers, China's market regulator, has released draft rules seeking to stop unfair competition in the internet sector. The rand is also weaker, in line with mildly risk-off sentiment, driven in part by concerns over the Delta variant. To help us talk through these and other stories driving market activity, we're joined by independent analyst Jimmy Moyaha. Jimmy, good morning to you, and thank you so much for your time. Let's just begin here. After slipping at the start of the week amid disappointing data from China weighed on global sentiment, how has the JSE opened this morning?
Good morning. So the JSE opened slightly firmer this morning. It's trading up, the top 40 is up about just over 0.5%, with one of the biggest performers there being the BHP Group. They're trading up almost 10% at the moment, following their release of their results. Naspers has weighed in heavily following that announcement out of China around the tech space. They're trading down about 4%. Process as well is trading down about 1% there. We know, of course, that Process holds almost about $167 billion worth of the Tencent holding on behalf of Naspers. So we expect to see that will affect the performance following what China's released around there. We have also seen that the rand has weakened slightly. It's trading around 14 Rand 92 at the moment. And again, that's largely off the back of risk-averse sentiment globally as concerns around the Delta variant increase, as you mentioned.
And let's talk about this. I mean, a lot of people have been talking about these oil prices, that also appear to be slightly mixed in early trade. After declines, this, of course, in previous 3 sessions, talk to us what is driving these sentiments.
So, of course, from an oil perspective, one of the big driving sentiments is going to be the demand in China. China, we know, is the second largest consumer of oil globally, and they've had a slowdown in demand. They've released sets of numbers this week and last week that have been negative, so they've missed some estimates in terms of returning to full production. They're also seeing concerns around a resurgence in the Delta variant, and their sort of propensity for imports has declined in that respect. They've taken more a precautionary approach, but that coupled with the fact that, if we remember a little while ago, the OPEC plus countries agreed to increase supply output, and that happened right at the time that China's demand started to decrease. And so we had this huge agreement on increasing supply, but at the same time a decrease in demand, and that's obviously going to affect and drive the oil price lower. And I think the global uncertainty around the ability to return to full production with this new variant of COVID is going to continue to weigh heavily on sentiment. We have seen it affect safe havens as well. I mean, gold is trading just below that $1,800 a mark barrel. So we're definitely seeing that overall the sentiment around the world and around oil prices and around the tensions that are happening in the Middle East as well, they're all having a bigger effect on not only the oil prices but on global sentiment.
And let's move on then to company news as we look at this developing story. I mean, MTN, could it be facing a fresh crisis in Afghanistan? This, of course, looking at the Taliban fighters taking control of their capital.
So political instability and the sort of tension in any country will definitely have an effect on the numbers of a company that's performing in that space. You know that MTN has been in Afghanistan since about 2006, and they have been operating in that region. They're the largest telecommunications provider in that region at the moment from an internet perspective. And so it might have an effect, but I think for MTN it'll be more of a wait-and-see approach, just because first of all, the revenue that they get out of that particular region in Afghanistan is probably close to about 5 million of their 170 or 180 odd million. That was reported in 2020, but that includes areas like Yemen as well. I think what's going to be a bigger play to look at is how the situation in Afghanistan is contained. If we look at it from a political standpoint and we look at a deeper reasoning behind how this has taken place, this has been ongoing negotiations from when President Donald Trump was still the President of the United States, in an agreement with the Taliban to start releasing some of their key leaders. And I mean, we know that the US has done that. They released one of the Taliban's leaders that was being held in Pakistan, and that was part of an agreement to say that if the US is able to leave peacefully, then the Taliban can sort of get some of their key leaders back and start to gain control back. So this negotiation has been going on with the Taliban for quite some time. I think the bigger question here and the bigger factor that's going to be affecting everybody and the oil prices and the global economy is the situation in Afghanistan. If we're able to contain it within Afghanistan and it doesn't spill over into neighboring countries. You know, Afghanistan borders 6 countries, 3 of which are global oil producers, and a 4th is China. And so if the tensions and the situation with the Taliban spills over into the neighboring countries, that's where we could start to see a bigger problem from an economic standpoint and from a global risk standpoint. For the moment, the Taliban hasn't expressed an interest in going that route, and the neighboring countries have also taken the stance to deploy troops to their borders in anticipation of what might happen. So for the moment, while the situation remains as is and unaffecting of the neighboring countries as much, we can expect that the global economy will be looking at other factors like the Delta variant to drive overall sentiment rather than whether or not the Taliban is able to take back full control as they have been of Afghanistan. But I think from an MTN perspective and other countries operating within Afghanistan, it's going to be a very tense time for them because, as we said, just any instability or any situation like this is going to drive uncertainty and tensions around whether or not you're going to be able to continue operating. The message from the Taliban has, of course, come out as, for the time being, things will remain largely the same, and it's to see whether or not that does hold true.
And you raise a very important question. They cannot be contained within Afghanistan. It certainly is going to be important going forward. But let's come back home now. Public Enterprises Minister Pravin Gordhan has an ambitious goal of getting state ports and rail giant Transnet to secure up to 100 billion rand in new infrastructure investments into South Africa's constrained ports over the next 5 years. Just how realistic would you say, Jimmy, is this target?
Well, I think depending on how it's strategically deployed, it's a very realistic target and it's a very good move that will yield very positive results. If you look at South Africa, we're a largely importing nation, and so a controller or the ability to get involved in our ports is something that a private entity or private investors would see very interesting and would be very interested in looking at that opportunity, because you'd be able to sort of play a part in the economy and play a part in a critical portion of the economy. What's going to be interesting is going to be what strings are attached to this sort of thing. The early conversation around this is it's been conversations around the Durban port and potential development and increase in infrastructure around certain other areas. And depending on how that's rolled out, if the company that comes in or the companies that come in are able to continue to operate in a private capacity, and we sort of see them being given the autonomy to operate and run those ports as the private ports, then you could definitely see an increase and a positive result from it. I mean, if you look at DP World, one of the companies that we know is going to be interested in this sort of deal, what they recently did in Kenya and Somalia by upgrading the infrastructure ports there to allow access to East Africa via that channel, that's bode well for them, and that's increased their footprint in that respect. Now, South Africa's positioning, not only geographically but also on the continent of Africa from an economic standpoint, is a very good opportunity for a company like DP World to come in. But if the government is going to attach a lot of strings to coming in on those ports and say heavy taxes or attach a lot of unattractive conditions around the management of those ports and the benefit for those individual investors, then we might not see the investors come in. But it is a good idea to get an investor in or investors in around that port stability to ensure that we don't have as much of an impact from civil unrest situations that we saw recently, but also to ensure that the smooth running of goods and services in and out of South Africa and Africa. I mean, we know that South Africa is one of the big gateway regions into getting into the SADC region, but also into getting into the rest of Africa. So from an economic standpoint and from a sensibility standpoint, this is a very good opportunity for a company such as DP World or another private investor to come in. We know DP World, of course, has recently acquired Imperial Logistics, so they could look to add this to their book as well, and we could very well see them come in as one of the key players for that stake. But again, it's about how the government is going to attract that investor or those investors, and what the benefit is going to be there versus what the terms and conditions are going to be.
Independent analyst Jimmy Moyaha, thank you so much for your time this morning.